there and welcome to Dukascopy TV. Today we're asking ourselves the question, why have European equity markets continued to rally? Well, joining me to discuss this is Marc and Webb, partner at Argos Investment Managers. Welcome.
Hello, Sinead.
Well, firstly, why have European equities risen?
Well, over the last few years, as world stock markets, and particularly the US, have been rising very, very sharply, a lot of investors have said in the media and on a number of occasions that the stock markets are overvalued. And it's true when you look at valuation multiples in terms of price earnings, that we are at historically high levels. And one can understand there's being a little bit of skepticism about the rise in the market. However, when you look at the alternatives to investing in equities in a very low interest rate environment, there are not many alternatives that yield enough to generate returns on investments. We've seen the US market has risen very sharply over the last years. Here we can see it outperformed the European markets very significantly. The US has benefited from a very strong economy, benefited from quantitative easing, which started 5 years ago, and therefore has had a very strong tailwind at the same time as the dollar was weak. It's now turning around the other way. The euro has already been weakening over the last few months, and as we saw last week, the European Central Bank came in with quantitative easing, which should improve confidence further.
So you've mentioned quantitative easing. Will that be enough to kickstart the European economy?
Well, quantitative easing will make sure that interest rates remain low or even go lower. It will generate a lot of liquidity in the markets. It's also accelerated the fall in the euro, which makes European companies more competitive in their exports. And generally, it creates greater confidence in all the economic players in Europe. So one can consider that yes, the stock markets have continued higher thanks to partly to quantitative easing and the confidence that will come with that. The fall in the euro, we've come down to about 112 against the dollar, significantly lower than where we were just a year ago when we were up about 140. So European companies are going to benefit on the one hand from being much more competitive compared to their American peers, and at the same time generate better margins. So the US companies, which we're starting to see already, Procter & Gamble, Caterpillar, who are publishing their fourth quarter results recently, are slightly disappointing because the weakness of foreign currencies against the dollar is having a negative impact on their profitability. This is what we should start seeing the other way around for Europe, because with the weakness of the currency, we're likely to see market share gains against international peers and better profit margins overall. And I suppose in Europe still, there's not that much confidence. People are still saying that Europe is in a no-growth area for the next 5 years or even forever. So expectations are extremely low and there is room for positive surprises.
So you say there's room for positive surprises, but are you not concerned about the political situation in Greece?
Well, what's slightly encouraging about the Greek situation is the reaction of the markets. The fact that the markets were quite steady coming out of the weekend is really proof that the euro crisis is very much behind us, and the importance of Greece to the European markets has been brought back to that of a country of 11 million inhabitants, which is roughly 3% of the European population. So it's very encouraging to see that that we can now have a quite worrying political situation in a small member country without the euro suffering too much.
So which areas of the equity market do you find attractive now?
Well, if one considers that equities in the US have rallied well ahead of Europe, and that Europe is therefore behind with quantitative easing, a weak currency, and also, of course, the fall in the oil price are all things that are likely to stimulate earnings growth in European companies. It seems as though European companies probably had earnings growth of around 10% last year, and we could expect this year 10% plus. Then that could be the region that's likely to most favoured this year, or could generate the most positive surprises. Within Europe, there's, in terms of market capitalizations, there's been the trend we've seen around the world of people buying ETFs, which means there's been a focus on the larger cap companies. So as contrarians, we'd probably say it's the right time to be looking at smaller cap companies. And as we're coming out of an era of low growth for European companies, there's been a premium paid by the stock market for companies that have their own growth companies, which because they've been bought by investors, have reached fairly high valuations. What we favour now are those companies that will benefit from better growth prospects in Europe, where expectations are very low.
That's fantastic. Thank you so much for your insight today, Marc. It's been a pleasure to have you.
Thank you.
Well, that's all from us here at Dukascopy. Thanks for tuning in, and remember to keep clicking back. Bye for now.